I have the title here. The title, of course, is about this company called the W Group. So we have a statement of cash flows for that particular period. Now we have the three items that I must write at the same time. So we have operating activities. Then we have, in this case here, investing activities. Investing activities. If my board was big enough, I would have straight away written down here finance, but my board is not very good. My board is not very good, it's not very big. So I'll come and write here, financing activities. Financing activities. I skip some line, and then I'll come and mention here, add cash and the cash equivalents, and the cash equivalents, and the cash equivalents, and the cash equivalents brought forward. I write like that. So add cash and the cash equivalents, add the cash and cash equivalents brought forward to be able to get, in this case here, the cash and the cash equivalent carried forward. So add the cash and the cash equivalent brought forward. I can see there are a lot of communications here. Maybe I should write the question. This is August 2022. This is August 2022. Question number 5B. Now we should relax, We should relax and then we concentrate. Is there a problem? What we are doing in this cash flow statement, we know that we will have to give cash flows generated from three activities or sections. So we have cash flow generated from operating activities, cash flow generated from investing activities. We have cash flow generated from financing activities like that. And then, of course, for reconciliation purposes, we have this segment, add cash and the cash equivalents brought forward. And then at the end of the day, you should be able to get the cash and cash equivalents carried forward. So then should I get, in this case here, this kind of a question? What are the low-hanging fruits that I should be able to pick? Let me show you the low-hanging fruits. You should never, ukipata mwanafunzi mwenye anakosa swali ya group cash flow, that student has a problem. And as I told you yesterday, it's quite a bad language. Let me not use that language today. So in this case here, look for the cash. You see, we have cash and the cash equivalent. This cash and cash equivalent for 2021, this is the opening, this is the cash and cash equivalent, which was brought forward for 2021. And then we have the cash and cash equivalent carried forward for 2022. But you must be very careful. Whenever you are getting this cash and the cash equivalent, you must be careful. If there is any overdraft, it must be subtracted. If there is any overdraft, so you must go to current liabilities to check whether there are any overdrafts. No overdrafts there. And remember, when you are given like cash, and then somewhere they give you, for example, like the short term, right? These short-term financial instruments. Short-term, I'll come to that concept. We don't have those concepts here today. So in this case here, what I'm going to do for free marks, I can see cash and cash equivalent, which was brought forward. It was 344. 344. This is what I write, 344. So we have here 344. This is what I write here. And then we have the cash and cash equivalent at the end of this current financial year is 160. Is 160. Is 100 and what year? And 60. This one here. This one here. So first of all, up to there, are we together now? Up to there. If you look at the marking scheme, the guy that I told to send this marking scheme must have forgotten. If you look at the marking scheme, they are giving you one mark here, one tick there. And of course, as we learned the other day, those ticks, they'll come and count them like any 6 at 2. You'll be surprised you're getting a lot of marks really there without even knowing what you're doing. So that is where you start from. That's where you start from. The other free mark, remember, when you come to operating activities, we always start with the profit before what your tax for the group. This is another free mark. So profit before tax. This is August 2022, remember, August 2022. So this profit before tax, it has been provided here, profit before tax. So the profit before tax is here. Profit before tax is here. It is 100 what year? It is 100 and, am I the one? No. It is 1464. 1464. Remember, here we had what we called a discontinued operation. There is an operation that was discontinued. Remember, whatever we have here as 1464 is a profit before tax for continuing the operations you're going to continue with. In the year, we had some subsidiary that we disposed, that in this case here we were able to discontinue. And if you look at this discontinued operation down here, if you look at the discontinued operation down here, you'll be able to see here the loss for the period from the discontinued operations in the consolidated statement of P&L and other comprehensive incomes related to C Limited, which was disposed, and is analyzed as follows. So I'm interested in the profit before tax of the discontinued operation. So I will take this 1464, I add this 48, the PBT of the discontinued operation. So plus 48 here, plus 48. Ladies and gentlemen, remember what we are saying is that we are looking for the profit before tax for the entire group for the year. And this profit before tax will be the profit before tax for the continuing operations into the future and the profit before tax of discontinued, because I'm interested in the total profit before tax that was earned by the entire group, So could you be kind enough and give me this answer? Could you be kind enough and give me this answer? Please give me this answer. Please give me this answer. 1512. So we have here 1512. Thank you so much. 1512 like that. So then after that, ladies and gentlemen, I'll come and remember the adjustments here. Remember, you'll come and mention here adjusted for, dial God's number for food. You dial God's number for food. Otherwise, you shall rest in peace. Otherwise, you shall rest in peace. Otherwise, you shall rest in peace. You shall rest in peace. Otherwise, you shall rest in peace. So remember, if I'm the one, I'll even come and start from down here. These are the working capital changes, the WC changes. So we have here receivables. This I stands for inventory. This P stands for who? For payables. Remember, as we discussed yesterday, our role here basically will be to look at what we call the OC. Opening minus closing. Opening minus closing. Just that. And if there was any subsidiary in the year that was disposed, then we must also subtract the figure, the corresponding figure of the disposed subsidiary. So we start with receivables. So please go to your balance sheet, So the balance sheet that we have here, two of them, the statement of financial position that we have here, we can see vividly where we are given, in this case here under current assets, we can see trade receivables. It is 832 is the opening minus the closing of 920. So 832 minus 920. So it is 832 minus 920. Remember, it's opening minus closing. Opening is 2021 is the opening year. 2022 is the closing year. So you take the 2021 receivable figure, you subtract the 2022 receivable figure, and then you ask yourself, remember they told us that there was a disposal. And if there is a disposal, in note number 3, the carrying values in the individual accounts of C Limited as at the date of disposal are given. You can see the carrying values, and we happen to be having trade receivables, which I can vividly see they are worth 220 because this was disposal, then straight away I need to come and say minus 220. In some cases, they'll tell you that a subsidiary was acquired. So if it was a subsidiary acquired, assuming this subsidiary that was acquired came with receivables of 220, then I would have done what here? Added. I would have added. So if it's a subsidiary acquired, whatever items they come with, you add. If it's a subsidiary disposed, whatever corresponding items it goes with, you subtract. You subtract. You subtract. So could you kindly give me this figure? Could you kindly give me this figure? Kindly give me this figure. 308 negative. So if it's negative, you simply write there negative 308, like that, like that. Remember, it is opening 2021 minus closing always. And because it's an asset, no problem. The same case with this inventory. It's opening minus closing. So could you kindly look for the inventory, and they give us figures. So inventory, what do we have here for inventory? Inventory, what do we have here for inventory? So one thing that I can see is that there was a disposed inventory with this subsidiary of 804. Of 804. So that I don't again come back to this. I can see inventory disposed of 304. Inventory disposed with this subsidiary 304. So when I go to my balance sheet, inventories, I'm able to see the opening is 1320 minus 944. So 1320 minus 944 minus that 304 that was that went with the disposed subsidiary. That went with the disposed subsidiary. I hope you're able to remember that. So then this gives us what inventory figure to put there. Inventory working capital change 72 positive, like that. So this is 72, like that. From there we have payables. So for payables, the same. Take opening minus closing. Opening minus closing. So for payables, the same. Take opening minus closing. The same. Take opening minus closing. Payables, they're here. So opening is 740 minus 376. So 740 minus 376. Do we have any payables in the subsidiary that was disposed? Do we have any payables for the subsidiary that was disposed? Let's check payables for the subsidiary that was disposed. Payables for the subsidiary that was disposed. The payables in this case were worth what here? 80. The payables were worth 80. The payables were worth 80, 80. It is 328 minus, oh, where did I get this really? Where did I read this really? Thank you so much. I'm being told, Mwalimu, you're wrong. Because payables, Mwalimu, your eyes are not nice. Because payables, they're here. You're right, I'm wrong. It is 328 minus 288. So 328 minus 288. And then we have in this case here the disposed subsidiary. The disposed subsidiary had a payable. This disposed subsidiary had a payable of 80 if I'm not wrong. So then could you kindly give me an answer here? Kindly give me an answer. And again, don't forget the fact that this payable is a liability. Liabilities, whenever you get answers for your signs to be correct, whenever you get your answers, you must reverse the sign by multiplying them with -1. Only liabilities. You must reverse the sign, thereby multiplying them what here with -1 to get the correct answer, so that you avoid that language that the payables have increased, blah, blah, blah. We don't want that language. So then what are we getting here? Is there somebody who's getting 40 negative? Is there anybody who is getting 40 negative? They are telling me that the answer is supposed to be 40 negative. 40 negative. So up to there, are we together? Up to there, are we together? Up to there, are we together? And if I'm the one, remember, whenever this examiner wants to complicate life for students in cash flow, they'll give you 2 subsidiaries acquired. Or rather, one subsidiary is acquired in the year and another one is disposed. There is no reason to worry at all. The thing is, if it's payables, the one that was acquired, if it has payables, you add. The one that was disposed, if it has payables, its figure of payables, you do what? You subtract. You subtract. There is that kind of a question, and I think I did that question It's on YouTube if I'm not wrong. If I'm not wrong, I'll be able to identify. There is a time they gave us a question that had got a subsidiary acquired in the same year and another subsidiary disposed, and so many students really got lost for reasons that I can't understand, because to me, these are very simple things. I mean, this thing was acquired. It has got this payable. So if it's an acquisition payable, I add. If it's a disposal payable, I subtract. Okay. So I'm being told that the answer is positive. I'm not so sure that the answer is positive. So if you take 328 minus 288 minus 80, without multiplying with this, what are we getting, somebody? Is this answer here positive or negative? When you subtract, of course, this will be negative. So when you multiply with this negative 1, it becomes positive 40. It becomes positive 40, yes. Then you multiply, it becomes positive 40. Becomes positive 40. Thank you so much. And then now here, we have depreciation. We have, in this case here, impairment, loss. That's for goodwill. Then we have, in this case here, amortization of intangible assets. Then we have loss on disposal. And then remember, when we talk of loss on disposal, two things. It is loss on disposal of assets or a loss on disposal of a subsidiary. So you'll have to do like this subsidiary that was disposed. Did we make a loss or did we make a profit? Right? And then you come here. So here we have here gain again, gain on disposal. We shall be doing this arithmetic here. Right? And then we have here finance cost. So when you are doing this concept down, you must be very generous with the space. Please be very generous. Like now I expected, because these three things are supposed to be the last things, I expect you guys to be having a lot of spaces in between. You can even write depreciation, skip a line, impairment, skip a line, amortization, skip a line. You skip lines in between because we shall be adding a few things here and there. And then now you go for the quick wins. So for the quick wins, like now when I look at this thing very fast, like when I go to my income statement, income statement, before I even do what I want to tell you, I look for simple things like depreciation. The loss for the period. You can see we have a loss on what here? Disposal. I'll be bringing that. So then we have note 5 here, right? Note number 6. There is a note talking about depreciation. I'm looking. So note 7, yes. There were no disposals of property, plant, and equipment during the year, except on the sale of C Limited. Depreciation for the year was 160, and it's included within the cost of sales. I mean, that 160, you pick it the way it is. You come here and add it back. You're adding it back. 160, depreciation. All right. And then you continue like that. You continue like that. Free marks, really. You're first of all going for free, just free marks. Like, you know, the other area where you'll be able to get a lot of, let me show you something here. Yes, look at note number 6. On 1st April 2021, W Limited commenced development expenditure on product Q. The product is expected to be launched in the year 2023. Shillings 56 million amortization on other intangible assets is included. So this 56 million amortization should not be charged. Remember, these are what here? Non-cash items, and yet we are doing a cash flow statement. So you have amortization of intangible assets. You come and put what here? 56. All right, I can see one new message. Oh, this will give good space. Rest in peace, finance and tax. Okay. I like that. I'm learning something very important there. Thank you, Muna. Thank you. Great. So you continue like that. But of course, if I'm the one doing this, already now I'm posting things here. So like I can come and post things under what here? Under financing activities, because financing activities, there is very little under financing activities. Basically, we talk about what here? Free marks. Free marks. So under financing activities, what do we have here? Under financing activities, what do we have here? Financing activities, we're looking at the equity and any long-term loans. So financing activities, I come here, very easy things really. So like now I want to know whether we issued any share capital. You can see share capital, there's nothing. 800, 800. Look at long-term loans, the way of financing ourselves. For long-term loans, I can see we have here, we had 960. By the end of the year, we had 600 and what year? 688. We had 688. So then I'll talk of 960 minus 688. So I'll come and write the name long-term loan. Long-term loan. So long-term loan, I can see we were at 960 opening minus closing minus closing of 688. Closing of 688. Right? Remember, this is what here? This is a liability. There must be reversal of the sign. There must be reversal of the sign. So times minus 1. Times minus 1. Remember, in the notes, I'm quite keen because you must look at the notes and see whether there is any item that affected loan notes. In this case here, there is no any note talking about what year? Loan notes that were whatever. No. So it means what 960, now that you're at 688, we must have repaid some loan notes. So we can multiply in a negative 1, and negative 200 what year? 272, negative 272, like that. Negative 272, like that. Now, remember, we also have some other financials. We have other financials, in this case here called who? NCI. NCI. We have some financials in this case here called NCI. So it will be very good for you to do what here to pay them their dividends. NCI, remember NCI, they also come under financing. So we pay them. So come and mention there dividends, very important. These guys are financiers. It is debt equity, right? They've given us long-term source of capital. So you come and mention here dividends paid to NCI. So then meaning that you need a working for what here somebody, you need this working for the NCI. NCI really, there is nothing much there. There is nothing much for NCI. There is nothing much for NCI. But if I'm the one doing this question, it will be very important. You know, NCI and the Goodwill, they are very much connected, those two things. NCI and the Goodwill, they are very much connected. And if that is the case, then I would rather start with a working on Goodwill. And the Goodwill working that I'll always start with is Goodwill for subsidiary acquired in the year or subsidiary disposed of in the year. Here we never had any subsidiary acquired, but we have a disposed subsidiary. We have a disposed subsidiary. So then what I'll do, not in between here, now I'm doing this just outside there. These are those working that will not give me any mark, but they are very important here. So then I'll come and talk over Goodwill of disposed subsidiary. Disposed subsidiary. And this semester, you guys could be very lucky from the example that you are doing. There is a very big possibility of you guys being given a consolidation question involving a disposal of a subsidiary, full disposal. So this question that I'm doing here is helping me cut, or rather even kill, two birds with one stone. So when there is any subsidiary that has been disposed, what do we do? So we must calculate goodwill on this particular subsidiary that was disposed. And how do we do it? It's your normal goodwill calculation. It's your normal goodwill calculation. You look at how much do you pay for the assets vis-a-vis the value of the net assets. So how much we paid, there are two stakeholders, remember. We only had 80% of this company. So there must have been another party that had 20%. So we have the parent and we have NCI. So two considerations. So come and give us purchase consideration, purchase consideration. So purchase consideration, the parent company, for the parent company. And then give us NCI at fair value at acquisition, at fair value at acquisition. So please go ahead and give us these. Go ahead and give us this. So, ladies and gentlemen, purchase consideration for this subsidiary that was disposed here during the year ended the 31st March 2022. W Group disposed of in its entire 80% shareholding in C Limited for cash. The shares had been acquired on 1st October 2017 for a cash consideration of 1056. So the cash that was paid by the parent was 1056. And then they are telling us, ladies and gentlemen, there that the fair value of the net assets of C 1980, this will come later. The fair value of NCI at acquisition was 224. So in this case here, we have, ladies and gentlemen, we have here NCI at fair value of NCI at acquisition, 224, and then we less the net assets of the company. The net assets of the company. And net assets of the company have been provided. The net assets have been provided. The value of the net assets has been provided. So the same net assets is 980. Net assets here is 980. The net assets here is 980. So you subtract this for you to give me the goodwill at acquisition. Give me the goodwill at acquisition. Is there somebody who already has this figure? I can see answers here. Goodwill at acquisition, 300, eh? Thank you so much, Brandy, 300. So once you acquire this kind of an asset, just like any other asset, just like yourself, right now, as we said yesterday, you are really, really glamorous. But after 20 years down the line today, you'll be our age mate. Utakume beat. So the same case with goodwill. It cannot remain at 300 forever. We expect it to lose value. So there must be loss of value. So in this case, the loss of value of goodwill is what we call impairment. So come and give us the impairment loss for this goodwill of company C that was disposed. So, and they have given us really, they have given us the criteria to use. What have they told us there? They have given us the criteria to use. They have given us the criteria to use. What have they told us? They've told us goodwill calculated under full fair value method was tested annually for impairment as 31st March 2021. Goodwill relating to C Limited had been impaired by, remember, goodwill of C Limited had been impaired by 75%. Had been impaired by 70. So impairment loss will be 75% of the 300, which gives me what here, somebody 200 and something, 225. That is what you subtract there for you to get goodwill at reporting. Good at disposal, because this was disposed. Goodwill at disposal. This was disposed, remember. Remember that this was disposed. This was disposed. So, ladies and gentlemen, what figure are we getting here? What figure are we getting here? What figure are we getting here, really? So, Nasema, this goodwill at disposal is 75. Thank you so much. Thank you so much. Thank you so much. So then I would want us to look at the impairment loss. I would want us to look at the impairment loss. We calculate now the impairment loss before we go to, you know, C was not the only subsidiary. This was just one subsidiary that was disposed. There are other subsidiaries that are well within W. So don't think that whatever you have gotten here as the impairment loss is what you are coming to book here. No, we have a goodwill account which is showing changes, which is showing movements. We have a goodwill account. And for us to be able to know how much of this total goodwill was impaired, then look at the goodwill account. Under the assets, we have goodwill. I don't know whether you guys are able to see under the assets, we have goodwill. We have goodwill. So under this goodwill, ladies and gentlemen, then what are we able to see? At the beginning, goodwill was 152. At the end, the goodwill was 32. What may have happened? Two things. One is because of the goodwill that went away with this subsidiary C, and then of course there must be impairment. So ladies and gentlemen, then this will be obtained as follows. When I do this goodwill account, I'll start with 152. So here, if you're seeing my board very well, to get the impairment loss, we normally work with goodwill account. I'm repeating again that to get impairment loss for the entire goodwill, we always work with goodwill account. And how do we do this? It's very easy. We take the goodwill brought forward, this 152, OC. So 152. So this 152, we subtract 32. We subtract 32. The goodwill carried forward, 32. And then remember, there was a subsidiary that was disposed in the year, whose goodwill that went was 75. Anything extra will be the impairment loss. If we had acquired a subsidiary in the year, then I would have brought the goodwill of this new subsidiary and added here. So take goodwill at the beginning, goodwill in this case at the end, subtract. If there is any goodwill for a new subsidiary acquired, you add. Any goodwill for any subsidiary disposed, you subtract. So what figure are we getting somebody? What figure are they getting somebody here? They are not talking to me for reasons in this case here really known to them. They are not talking to me for some reasons not known to me. They're not talking to me. 45, wanasema the answer here, yep, wanasema ni 45. So this impairment loss is 45. Now, ladies and gentlemen, I would want us to move in a very, very systematic way. If you are to be asked, and please be very honest with me, like if somebody asked you, what have you learned out of this simple working of impairment loss? How would you summarize the skills learned? They are not talking to me. I don't know why, and I really want to help them. And from my experience, by the way, even by the time you reach here, you have gotten like almost all the marks I showed you yesterday. Actually, if I'm the one doing this question, now I'll only be looking for like 2 entries alone. I'll be looking for like 2 entries alone, and I'll be done. Great. So you have learned so many things there. Dial, God's number, whatever. Somebody has learned there that we will have to discuss goodwill for disposed / acquired subsidiary. Thank you very much. Now let me ask you a question. With a CPA Norbert, your teacher, have you done any group cash flow question that has got an acquisition, a subsidiary that was acquired? Have you done? Great. So if you connect this with whatever he taught you, and I would want you to look at the question that you did with him. Don't start doing any fresh questions now. If I were you, like after I've done this, I'll go and ask myself, this question that we did with CPA Norbert, right? Can I do it now using this shortcut and see how many marks I'll be able to harvest? Because it can't be an AFR, exam if it doesn't have what your group cash flows. Promise me that you will do that. Like tomorrow. Very important. Very important. You must do that like tomorrow. Because if they want to complicate your life, they'll bring you a subsidiary acquired in between and a subsidiary disposed. Thank you so much. Then if that is the case, I would want us straight away then to look at NCI in this disposed company. NCI NCI of C. NCI of C. Very easy, really. NCI of C. NCI of C. Kama ni mimi, nitawafurahisha sana vile. If you're very keen to kitu sana. Kama ni mimi, hata sisi fanya hizo waki nawaambia. Mimi kuna mali naguza hapa na pale, and that is why, like when I was doing my CPA, we used to call this one FA4. I was the best student. When I was doing ACCA, SBR, strategic business reporting, it's the same as advanced financial reporting. I was number 19 globally, and not even a single question of mine has ever balanced. I don't want it to balance. For me, it is maximizing on the number of what are correct entries, on the number of correct entries. The moment you understand how to get many correct entries, then you will be at home. You'll be at home. You will be at home. You will be at home. Great. Just a moment. Thank you. So now we are looking at NCI of C, which is a disposed subsidiary. Very important to have this working. So we're looking at NCI at acquisition. Are you able to remember that from note number 1? NCI at acquisition. They're saying it is 224, isn't it? It is 224. And then if you remember this method, they will grow with the PUP. So give them their share of what here? Give them their share of PUP. PUP is post-acquisition profit. PUP is post-acquisition profit. How do we get post-acquisition profit? It's very easy. It is net assets of the company at the beginning, at acquisition. And in this case here, the net assets of the company at disposal. At disposal. PUP is post-acquisition profit. How did this company grow with the time? So when you look at the net assets, when we were acquiring this company, we were told that the net assets here were 980. And as at the date of disposal, the carrying values in the individual accounts of C Limited, as at the date of disposal, are listed below. As at the date of disposal, the assets are here. They are worth 1220. There is growth. So then I'll take 1220 minus 980. I'll take 1220 minus 980. So 1220 minus 980. There's growth there. But now remember, they're not going to get everything here. They're not going to get everything here. These guys, they're only going to have their share. They're only going to have their share. So what is their share? Who can remind us the share of NCI? What is their share? Their share is 20%, isn't it? Because 80% is for the parent. It's for the parent. So times 20%. So could you kindly give me this figure? Could you kindly give me this figure? Could you kindly give me this figure? Wanasema ni 20. No. Lucy anasema ni 40 what year? Lucy anasema ni 48. 48. Thank you very much. We are adding these. Kutoka hapo kumbuka, kuna kala kaumbwa katawauma pia. Kuna asset yao which was impaired. Remember, there was goodwill for this particular company C which was disposed. We got goodwill and there was some total impairment of that goodwill of company C. If I remember, it was 300, isn't it? If I remember very well, it was 300. Ukweli ama uongo? Oh, 75%. 300, isn't it? So in this case here, 300 here. So we have here share of impairment loss. So share of impairment loss, remember, it is 300. 300 was the total impairment, and they can only take their percentage. They can only take their oh, it was 225. It was 225, right? Right, 225, and they can only take their percentage. Their percentage is 20. Their percentage is 20. So then what is 225 times 20? What is 225 times 20? Is there somebody who is able to give us this figure? What is 225 times 20? What is 225 times 20? Wanasema ni 40? 45. Unasema ni 45. 45. So 45, please subtract there for you to be able to give us the NCI of C. The NCI of C at disposal. The NCI of C at disposal. NCI of C at disposal inakuja ngapi? 227. NCI at disposal. NCI at disposal. NCI at disposal is 227. NCI at disposal is 227. Then come to the dividends paid to NCI. This is the easiest. This is another working that I can easily do after I've done. I will be able to guide you. It's only that I'm seeing time is really moving very fast. But there are those workings which are very important. Like now your dividends paid to NCI. What I'll do, I'll take NCI at the beginning. NCI, non-controlling interest at the beginning. What do we have here? NCI at the beginning. NCI at the beginning. NCI at the beginning. NCI at the beginning. If you look at NCI at the beginning, NCI at the beginning, NCI at the beginning. If you look at non-controlling interest, we have here 680. We have 680. So NCI at the beginning, we have 680. OC, remember, don't forget. So 680 minus NCI at the beginning, NCI at the end, NCI at the end, which is what somebody here, NCI at the end, oh yeah, abracadabra, abracadabra, NCI at the end, I can see abracadabra, it's 512. So minus 512, minus 512, minus 512. Then don't forget, hey, you, my good students, don't forget that we lost through disposal, we lost some NCI. We lost some NCI. So minus 227, minus 227. Then from there, ladies and gentlemen, without forgetting here, you must be a very bright student. Now, look at your entire income statement. Look at your entire income statement and see whether there are things affecting NCI. Na ni vitu same. Ni vitu same. Kama sasa ukiangalia hapa katika, ukiangalia vizuri katika comprehensive incomes, katika total comprehensive income, there is an income that was given to NCI, which is what here, somebody, which is 88. There's an income that was given to NCI. Na hii ni popular sana. Unaenda kwa total comprehensive income, unaona kuna ka income, unaongezea. So unasema hapa plus 88. Plus 88. And that is it. Whatever you will get out of this working automatically will be dividends paid to them. Dividends paid to them. And of course, because it's a liability account, you will have to multiply this with -1. You'll have to multiply this with -1. You'll have to multiply this with -1. You'll have to multiply this with -1. With -1. So anasema kwamba this one is negative what here? -29. It's -29, like that. -21. It's a liability account. NCA is a liability account, remember. Now, nikishafika hapa, of course, most of these others were done in our yesterday's class, but nikishafika hapa, the only other working I'm supposed to look at is the associate. And you see, associate is normally the easiest. Associate is normally the easiest to handle. The associate is normally the easiest to handle. If you're not able to handle an associate, then know that you have a problem as well. Associate is normally the easiest. So associate, we normally handle it here under investment. Associate, we normally handle associate here under the investment because we invested in an associate. So nakuja hapa ni yangu nilivuta. So here we have investment activities, unaanza hapa na investment in associate, and the associate we normally do two things. Remember, if you have invested in an associate, then we shall get a dividend from associate. Simple. So in this case here, dividend received, these are 2 marks free, received from associate, two things. So then, ladies and gentlemen, what I will do there, I will come here and look at this thing nicely. I'll come and look at this thing nicely. So go to your associate. Go to your associate here. go to your associate here, look at any associate that you have. Go to your investments. I hope you're able to see your investment in associate. So we began with 0. We began with 0. So minus 816. So I'll have to wrap this a little bit. Investment in associate. So we began with 0. In the sana. The associate was 0 at the beginning of the year. End of the year, it was 816. Now from there, I need to ask myself very fast. What will be able to affect my associate? The associate, what will be affecting my associate? What will be affecting my associate? What will be affecting my associate? My associate will always increase by the associate value, will always increase by the PAP, post-acquisition profit, will always increase by the profit it generates. So go to the income statement and look for the profit. Very easy, really. Income statement, profit. Are you able to see share of profit of associate 128? Right? This increases the value of the associate. So you add. So the same plus profits generated by the associate. And then this associate is going to pay dividends. When it pays dividends, of course, in this case here, its value goes down, because it's a cash outflow. So you reduce the value of the associate, but of course, you'll be taking the figure again separately here as the dividend. So in this case here, come and say here minus the dividend received. Is there somebody who is able to see the dividend received? Dividend received of this associate. Dividend received of the associate. Is there anybody who is able to see the dividend received? You'll be able to see where the associate has declared total dividends. Is there anybody who is able to see that note very fast? Here, W Limited purchased a 40% interest in an associate on this. The associate paid a dividend of 8 million. Now, here so many students forget that the associate is not theirs fully. This associate, you only own 40%. So in this case, you can only account for the dividends paid by the associate up to 80%. Remember, investment in associate is an asset, so you don't multiply with -1 to change the sign. So could you kindly give me this figure? Valentine, thank you very much. 32. Thank you very much. 32. And then the same figure that I don't know whether we are together there. Associate is very easy. You take the opening figure of the associate minus closing, and then you add the profit generated by what here, the associate, and then you subtract any dividend to your proportion. Dividend paid by the associate up to your proportion 40%. So are we together up to there? No, I think I've lost most of you. I must have lost most of you. They're not saying anything like yes or no. You are mastering. You see, associate is, you can't get a question in consolidation that doesn't have an associate. Associate will come, consolidation, associate in cash flows. So you need to master this. You can also decide to use a T account, but why should you stress yourself with T accounts and they will not give you any mark? And then, ladies and gentlemen, you must have been told by CPA Norbert that once you have done this investment in associate, this 32 was paid to the group. By paying it to the group, Irene is getting 720 negative. 720 negative. 720 negative. 720. Oh, I know what they are talking about. She is correct. This 32 is here. I'm stupid. So minus 720, like that. Thank you so much. Thank you. No wonder it took so long to respond whether you are comfortable. Now, once you have gotten this 32, remember it has reduced the value of the associate, but it has increased the group value because it's dividend to the group. So you come and mention here, the group invested in the associate. It's part of the group. So you come and say here, dividend received from associate. dividend received from associate, which is what here, 32 positive like that, 32 positive. The same figure, simply transfer. You must have done this with CPNO, but simply transfer like that. So now people will think that you're a very bright student, but there is no brightness. No, you're bright, of course. But the thing is, you have basically mastered the concepts here, and you're able to do these pretty fast. So then I'll be able to transfer a few things, like there was a loss on disposal of the subsidiary that I'll be able to pick very fast. This finance cost, I'll be able to calculate tax, but I can't do all that. You can see from the time I began teaching you, over an hour has gone by. But the good thing is that if I'm the one who was doing this, I would have done this exact working here in a maximum of 30 to 35 minutes. And then I'll not even look for any reconciliation, because I know how CASHFLWO marks. Trust you me. If you write like this, a question that has got, I showed you even yesterday, if the question has got 16 marks, these guys will come and tick like this, tick like this, tick all like this, tick these things like that, and then they'll say any eight at 2, which gives you how many marks? Which gives you 16 marks. So if you count these 1, 2, 3, 4, 5, 6, 7, 8, 9, you are more than 8. So you have your 16 marks. You go to a theory question and you also do justice to it. So what I'll do, I'll hang this particular video on YouTube. And then if possible, of course, you guys now have the solution. I'll be able to create time and do the whole of it. Is there any reason of doing the whole of it? Perhaps, and then I hang it as part B. Part B. Maybe for your future reference, when you become CPA, ISPAC members, and you would want to understand, because to me right now, it's all about just passing. Right? So if I were you between now, and the exam, I would master these concepts here. Yeah, I just want to pass. I'll master these concepts here, and then I ensure that I do another question that now has got an acquisition and a subsidiary. So I believe once you get these questions on YouTube, please, I'll always remind you guys to ensure that you subscribe and give me a thumbs up. I'm not a bad teacher. It's my belief, ladies and gentlemen, that this short session has been helpful to you, and you shall be able to use whatever concepts you have done here to pass. I don't want any fails here. Lucy, I've gained a lot today. Please do that to group accounts. Yes, I'll do that. Yes, please, I will do that. Otherwise, you guys are supposed to be starting advanced financial management. Allow me to do